Welcome to Getting Retirement Right, where we strive to simplify your financial life and provide you freedom from taxes, risk, stress, and poor advice. And now, here are your hosts, Darrin McComas and Shon Peil.
All right, everybody. Thank you so much for joining us. Episode 3, Getting Retirement Right. My name is Shon Peil.
And I'm Darrin McComas.
Excited to dig into some good information today. I think the first 2 episodes were really kind of laying the foundation, kind of bit by bit, on what we think is important and kind of what we really start to dive into here as a firm. There's a lot of craziness going on in today's market. The banks, let's just start off with banks. Major issues right now.
Yeah, we're seeing a lot of stress on the financial system. Some of these regional banks, serious trouble. We just had Silicon Valley Bank go under, Signature Bank in trouble, and a few others. And, you know, it's really tough to tell how far this contagion spreads and what other banks out there, even bigger banks, are in trouble. It's creating a lot of uncertainty and a lot of, a lack of confidence in the financial system, which can quickly spiral into panic and, you know, run on banks, and that bleeds over into, of course, the stock market.
Well, it kind of sums up the year so far, right? January takes off, unbelievable. It's a positive month. People are like, oh, here we go, market's back. And then all of a sudden, wipes away all of the gains.
Welcome to the roller coaster, right? It continues. 2022 saw huge drawdowns, followed by wild bounces in the market, followed by another drawdown. And that's typical of a bear market. You get these, you know, significant down moves, and then they're followed by significant bear market rallies. At the end of the day, though, you finish 2022 and you're down, almost 20% in the S&P 500. Tech stocks down around 30%. And then it's just more of the same here in 2023. And it has a lot of people anxious.
Well, and I hope there's a lot of people wondering if there's better options out there. You know, because if my account was down 20%, and I know if our clients' accounts were down 20%, they wouldn't be happy. And so the thing you have to ask yourself is, are you willing to get that second opinion, fresh perspective, and maybe listen to some new ways of doing things? Are you open-minded, right? And that's why we built this. Getting Retirement Right, whether it's a podcast, our community, any of the webinars or seminars we do, it really is about being open-minded.
Yeah, and it all starts, you know, we say this all the time, it all starts with having a plan. Mm-hmm. And your money needs to have a plan too. You can't have all your eggs in one basket or all your eggs in one portfolio model or a basket of stocks, you know. And then, you know, that worked out pretty well from 2009 to about 2020. It was kind of easy. And now we're in this period of time where the Fed is tightening, banks are tightening, the economy is slowing down, and the market is reacting to this in a very volatile manner. And, you know, and then people are wondering, well, what is this? This is not normal. I'm not used to this. The last 10 years were so much better.
Well, you got the interest rate issue, right? You got the housing market issue. And no matter where you look around the country, houses have been overpriced. Like, this happened in 2008, but here it is happening again. What do they say Americans learn from history? Nothing, but history has a way of repeating itself. So I think the one thing we do differently at this firm is there's zero cookie cutter options. And we're going to make darn sure that your money's doing what it needs to be doing. And we were just having this conversation. Talk us through a little bit about, oh, I'm conservative, or I like to be risky, and this whole risk score thing. It sounds great, but that set it, forget it method isn't working right now.
Yeah, you know, our industry is governed by, you know, risk management. And when you bring on a new client, they have to fill out a risk profile, and you get kind of pigeonholed into really 3 categories: conservative, moderate, or aggressive, or somewhere in between those. But and then, you know, if you're a conservative investor, guess what you get? At most banks, you get a conservative portfolio. It's very cookie cutter, but based off your risk profile, that's what you get. And we see just major issues with putting people, you know, investing them according just only to their risk profile. Because if we've learned anything the last couple of years, is risk is very emotional. You know, when times are good, money's flowing, the market's ripping, you might tend to score higher, more aggressive on those risk profiles.
Enjoy the ride, right?
Yep. And then volatility hits and your account's down 20% in 2 months and you're freaking out. And if you were to take that risk profile at that point, it would be a whole different outcome. So to us, risk is very emotional. It's driven. It changes over time as you maybe go from working to retirement, right? You kind of start to change your mindset, and we just feel there's a lot more to it than just a single risk questionnaire that is followed by a very cookie cutter portfolio.
Yeah, most definitely. And if the one thing we've learned in the last couple of years is life happens fast. Like things change quickly. And we can go back, right? A little bit before the major election and, people were worried all hell's going to break loose, right? Then there was the pandemic. So what we have seen is wherever your money's at, you hope to God that they're pivoting and moving. But the one thing we've seen over and over again is the bigger the bank, the less options you have. They brag about managing trillions of dollars, but yet they don't ever move it around.
Yeah, and the tighter their regulations, the bigger their compliance department. And we have an advisor in our office who used to work at a big bank, and he's given us some insight into the world of their compliance. And it's like those poor advisors, they're great people, but they literally can't move left or right without going through 15 layers of compliance to make a change in someone's account. And unfortunately, a lot of people are just left blowing in the wind, and a lot of advisors are just, their hands are tied.
Well, let's talk a little bit about it. I mean, we don't want to get geeky and we don't want to, bore everybody, but what's kind of the approach that you and the team take to managing the money? I mean, are you guessing? Are you up in the mornings turning on the same TV shows we all are turning on, or
we just totally wing it? We get the tea leaves out, and each morning, no, I'm just
there's
joking.
A dartboard, and you're hoping you get it right.
No, I think it starts with having a risk management process, right? And that should be based in real numbers, real data, not narratives, not intuitions,
emotions,
not feelings, or just simply looking at a single factor like the price of something. For us, our risk management process, we're not going to geek out too much, but it's pretty intensive. It starts early in the morning with the research from our analysts that we subscribe to and filtering through that, and then running it through a bunch of different lenses to see if we need to make any changes. And it's constantly evolving. Like you said, we've said it before, risk happens slowly and then all at once. And you saw that just the last few days with the banking fiasco and really spooked the market. So, does your advisor have a risk management process? Can they explain it? Is it based off a repeatable process based on math and real world data?
Or is it based off what the big bank analysts are saying? Because we see a lot of that. And we've seen, I won't call it insider trading, but we have seen a lot of nonsense in the news the last couple of years of people getting way out ahead of stuff. And that influences everything that's chosen on the back end.
Yeah, and it's even getting tougher today with the options markets. There's been a lot of new options tools out there. The most recent is 0 date to expiration options. So it's just pure speculation, but it can drive the market one way or the other. And then the retail crowd starts to chase, right? They get fear of missing out and they chase. And then all of a sudden these options the next day flip and they start going the other direction. And of course, the typical retail client is left holding the bag in this. And it's just definitely making risk management tougher with all this option manipulation and shenanigans going on.
Well, and I think that's why it's important to have a process, right? You're meeting with the analysts in the morning. The data is all forward-looking based on mathematical statistics. There's no emotion. It's not politics. It's not what the Fed's going to do. It's like, look, this is the direction we're going. We have to be able to move and pivot. And so I think that's incredibly important because what you don't want to consistently do is look at that TV screen to figure out how your accounts are doing. There needs to be a plan in place.
Yeah, and if you're watching some guru on TV that has this latest stock pick, I'm not going to name names, but
don't name names because boy, some of them are on a poor run.
Just about a month ago, this well-known stock guru picked Silicon Valley Bank as a must-own, and there's no accountability. It's all about clickbait, getting people to subscribe, getting people to watch, and it's so just driven by narratives and what's happening now, and there's really no repeatable process. It's just about drumming up interest and getting you to watch and tune in. And unfortunately, some people buy into it and actually put it in their accounts. And some advisors fall into that as well.
Yeah, we've seen it on a consistent basis. I mean, I just think back to, it wasn't very long ago that the meme stocks were taking off and companies that were filing for bankruptcy, all of a sudden their stock is soaring because hundreds of thousands of people on the internet decided, let's run up the stock. And so I think the thing that we get the crypto questions all the time, it's like, goodness gracious, this is your retirement. This is the money that you or your family will depend on for the rest of your lives and maybe theirs. So why would you want to wing it? And if you don't have somebody that's intimately watching and paying attention to everything we're talking about, it's time for a second opinion. Mm-hmm. It's time for just a fresh perspective, because here's what we know. A lot of different ways to do our business. And our business is led by arrogance. And I coach advisors all over this great country. And this morning, that was my conversation. It's like, stop selling, build good relationships. These are people. They don't get to go back and remake that $300,000 they just lost in the market. And so I would say right now, there's a lot of tangible urgency in today's market. If someone is selling you, run, because what they should be doing is asking you questions, trying to figure out your goals, your objectives, and what you want your money to do. Don't be afraid to remind yourself it's your money. You worked hard for it. Darrin and I didn't work for it. Your current advisor didn't work for it. You worked hard for it. What do you want it to do? Where do you want to see that go? What's that look like? How do you want to spend it? Whatever you're envisioning, those are your goals. Those are your dreams. Please make sure that money is doing what it should be doing to be aligned with those dreams. Because I don't know, 8 out of 10 times, 90% of the time people walk in and it's not even close.
It's not. And, you talk a lot about shifting your mindset, right?
I do.
In retirement. And it's tough because you've been working your whole life contributing to that, 401k, IRA. And then one day you're retired and now you're not contributing. In fact, you're reversing that. You're taking distributions out of that. And a lot of people have this anxiousness. They don't have a lot of confidence simply because you boil it down, they don't have a plan. They don't know if they have enough money. They don't know when to turn on Social Security. They don't know how they're going to pay for healthcare. There's so many factors. And this is, again, finding a good fiduciary who puts a plan together based off your values, your visions, your goals, and what you have and what kind of cash flow you need. And that's where we come in. We have a system. It is definitely not put all of your eggs in one basket in a certain portfolio model or a sleeve of stocks. We use a bucket system. Some people call it the tranche system. It sounds a little fancier, and it's all based off your plan. So we use eMoney, one of the best financial planning tools out there. And we work and we build out your goals and your vision. And we look, really, it comes down to what you need, your cash flow, what you need to start pulling out of these retirement savings accounts. And then what kind of growth rate do we need to get over your lifetime to make sure you have a high probability of success, not running out of money, right? Not having to go back to work later on, or, those retirement accounts are gone one day and you're just living off Social Security.
Yeah, I think it's really important to understand that inflation is not going anywhere. Taxes are considered to be at all-time lows. They're eventually going to go up. And there's going to be changes within how they make us take out RMDs. Maybe they make us increase those. But the one thing we learned, like I said, it's ever changing. This is a moving target. So why would your financial planning or lack thereof, or your money why would it be okay for it to be just sedentary when everything around you is moving? So to your point, right? You have to make sure that the money matches the goals and the dreams. Otherwise, guess what? You're going to run out of money, or you're going to be gone a day too soon, and your poor spouse is going to be sitting there trying to figure it all out. We've seen it happen. We both have aunts widowed before the age of 60. I say it all the time. But if you don't have a plan in place, and what do they tell us? 95% of Americans do not have a plan in place. Mm-hmm. That's crazy.
And just having retirement accounts is not a plan.
No, or different accounts, or at different banks. We hear that all the time. Oh, I spread out my risk. No, you didn't. Account A is at, say, a big bank. Account B is at a different big bank, and they're invested almost identical.
And they're not talking to each other.
No.
Right. They're not coordinating. And so, what we love about doing our financial planning is at the end of it, we get down, when we put it all in, put all the inputs in, it really gives us, we run some Monte Carlo analysis, and it gives us a probability of success. And it gives us a target growth rate that we should be aiming for. And for example, the client we just worked with, their growth rate needed to be around 3.4%, slightly higher than the rate of inflation. And they had a very high, almost 100% probability of never running out of money. The next client we worked with, their cash flow needs, they were, having a much more active lifestyle, pulling a lot more money from their accounts. Their growth rate projection said it was closer to 5% of what they needed for growth. And I'll go back to my point about the risk profile, right? If you're afraid of the markets and you get pigeonholed into this conservative portfolio, but your plan says you need to be a little bit more moderately invested to get that growth over the next 30 years to fully fund your lifestyle. If you stay invested as a conservative portfolio, a 60-40 portfolio, let's call it, you might have a high probability of running out of money in your late 70s, early 80s, just simply because your plan didn't match your lifestyle.
Yeah, that's kind of scary when you think about it, because look at the last couple of years. There's been safe portions of portfolios that are down 10 to 20%.
Last year, right? The 60-40 portfolio, 60% stocks, 40% bonds, stocks down around 20, bonds down around 15. In the newest projections on the 60-40 portfolio is an average annual return around a little over 2%.
A little over 2.
Not even really keeping up with inflation.
Not even close if inflation's above 6.
So, this is where looking at more than just risk, starting with a plan, looking at your goals and vision and your liabilities. What kind of retirement do you want? How much income do you need? It's so different for every single client we meet with.
Well, I think it's really important to understand too, like, we have a niche clientele that we work with. It's baby boomers. Our average client's right around 67 years old. What we're talking about is exactly where you guys are at in life. Like, you're not going to get to go back and redo this. And to Darrin's point, putting the money under the mattress isn't going to work, because a lot of you want to spend it or pass it on. With inflation where it's at, you really can't afford. With Medicare and the cost of healthcare, it's only going to go up. Taxes are only going to go up. We know that $100,000 now, within about 10 years, has a good chance of being less than $50,000 in spendable money. What is your plan of attack? And do you have one to combat inflation? Because we see it all the time. Oh, this money's just sitting over here. Well, that money's not making anything. And there are now instruments and tools that you and the team have to where clients can make good interest, stay relatively safe, and still be growing their portfolio.
And this is why we prefer the bucket system, right? Or the tranche system. So how we view that is we get a target growth rate from the financial planning. Let's say it's 3.5%. Then we look at what your nest egg is and what your cash flow needs are. And then we figure out how much should go into each bucket or each tranche. Bucket 1 is immediate income you need the next 1 to 3 years. That money needs to be safe. Mm-hmm. It cannot be on the market roller coaster. It cannot go down 30-40% in a market crash. It needs to be there to fund those distributions month after month for the next 3 years. So that money needs to be invested differently than the rest of your accounts. And then we get into bucket 2, which is 4 to 10 years out. And every bucket system's a little different, but that's a little longer. And for some people, we need to dial up the risk a little bit and be look for high dividends or moderate growth. Still protect it, preserve and grow it, but not be so ultra conservative with the whole bucket. And then bucket 3, that's our long-term money. That's 11 plus years out in time. So we can be a little bit more aggressive. We can have a little more volatility in that. And again, we're shooting for a higher growth rate in that, knowing we're going to go through some volatile times. But probably over the 15 years, I think you and I would bet the market's going to be higher than it is today.
Yes.
It's going to be a little bit of a roller coaster, but at least we don't have your entire life savings on that roller coaster. And if it doesn't work out, or you're just told to ride it out, right, during those tough years.
Well, and to quote a few of our clients, like your generation, the baby boomer generation, you don't want all your eggs in one basket. Like, we hear this all the time. But just because you have money at different banks, that doesn't mean they're in separate baskets. All too often it's the same. So with this methodology, they are separate baskets. And each basket is doing something different. And each basket really does meet a need. Because here's the one thing we can tell you. Our RMDs, required minimum distributions, they kick in at, say, 73. And you have all this extra money that you didn't plan on, and then that account goes down 20%. Or you decide you want to do some tax planning, and the account's down 20%. Or you want to help a kid or a grandkid with their first home. It's like, wait a minute. It didn't all need to be in that bucket. It could have grown over the last 5 to 7 years and been in a way better place than hoping the market's up when you need the money.
Well, let's face it, when your account's down 30%, and those stocks are down, and you have this built-in instinct not to sell and mark a loss in your account. So something has to get sacrificed, and too often that, okay, well, I'm going to have to go back to work. I got to let my stocks recover, or I got to cut the budget, or
we're not going to do a trip this year.
Exactly.
Yep. We're not going to go see the grandkids. We're not doing Disneyland. It's like, and we say this all the time. I say it all the time. Most of you listening right now or attend our workshops or whatever, you have enough money to do the things you want to do and be in a better position than you may even imagine. You just need to eliminate some of the nonsense. And we always believe that starts by being proactive, not reactive. People were caught last year or during the pandemic in horrific positions because there was no plan in place. No one was addressing that amount of risk that money needed to take. So I think it's very, very important to realize money has a way of working if it's in the right position.
Absolutely. And again, it's get your customized plan.
100%. Second opinion, fresh perspective. What do you have to lose?
And you may be able to execute it on your own if you feel confident that you can navigate the markets and do this, or you may need some professional help. And that's where finding a good advisor. We're fiduciary advisors in this firm. We have to put our clients' best interests ahead of ours. I think that is the bare minimum. If you're going to hire someone, make sure they're a fiduciary. That word gets thrown around very loosely. Look for someone who has a Series 65 license.
There
really.
You go.
Be specific. And that's one of the few licenses in our industry that by law, your advisor has to put your interest ahead of theirs. So, it's anxious times. 2023 has been a wild ride already. We're not even one quarter way through it yet.
And it's why we do this, though. We're building this community. We want you guys to be able to come and ask your questions. And I'm tired of all the sales pitches, quite honestly. They're out there a dime a dozen, whether it's webinar or dinner at seminars. Come and ask good questions. We're here to help. And we've all known, I'll just end it with this. We've all known someone that maybe with a health issue, wish they would have had a second opinion, really maybe did a little more research, and things might have turned out different for some of our loved ones. I know of a couple right now that I'm thinking of. The bottom line is you don't get to retire again. No one's going to put that money back into your account. And most of you are in a fine position. We just need to come alongside, make a few tweaks, and complement your hard work.
Yeah, and get that freedom. Get that freedom back into your life. So
it's out there. You just got to fight for it, right?
You got to fight for it.
You got to fight for it, and we're willing to help you fight for it. So episode 3, we're going to wrap up. I think we covered some great information. If you didn't get it, don't let it. Just set it and forget it. That does not work. No cookie cutter portfolios. And if you're at a big bank, why don't you explore your options? You probably have some good ones.
Yeah, get a free second opinion. Take some action. Get off the sidelines. If anything, this is going to be a wild ride in 2023. And you can either sit back and let it happen to you, or you can be proactive.
And it's not too late. I mean, that's the other thing. It's not too late to get that second opinion, fresh perspective. Go out there, make it a great day. We are signing off for Getting Retirement Right. My name's Shon Peil.
And I'm Darrin McComas.
You guys have a great day.
Thank you for listening to Getting Retirement Right. Make sure you subscribe so you don't miss any future episodes. For more resources, or if you have any specific financial questions, contact us at abrahamco.com. That's abrahamco.com. The Getting Retirement Right podcast and related materials are provided for general information and entertainment purposes only and do not constitute accounting, investing, legal, tax, or professional advice. Visitors should not act upon the content or information found here without first seeking appropriate advice from an accountant, financial advisor, lawyer, or other qualified professional.